Alright friends, once you have completed writing this entire summary, let us move ahead and now talk about the next important concept, that is capitalization of interest. So in the earlier part of this class, if you can remember, I have explained to you what are period costs. Interest falls into that category. So interest expense is periodic expense. Why? Because interest accrues with the passage of time. So interest expense is basically periodic expense, and under most circumstances periodic expenses are simply charged off as expense in the income statement. As a result, your profit is directly going to get affected because of interest expenses. However, there is one catch where interest expenses can be capitalized. Let me explain one point to you with an elaborate example. Suppose I have started constructing the factory building and machinery. That whole project is a long-term project which will take 2 years time. So all the construction cost, the building material, the labor work, the machinery expenses, the acquisition of machinery, installation of machinery, because this building and machinery is being constructed parallelly together simultaneously. The whole project will have 2 years life. I mean, it will take 2 years time to complete the construction, then only the factory can be used. So the construction period is 2 years. So every tiny bit of expenditure incurred during this construction phase will be part of the capital expenditure. So the factory building and machinery will be an asset that will be created out of all these expenditures. Now imagine that during this time, the funds that were needed for financing this construction activity were borrowed, and I have to pay interest. So if I am paying interest on borrowed funds, it is a borrowing cost that I am incurring. If I am incurring a borrowing cost in the form of interest and other expenses, if it is a borrowing cost and that borrowing cost pertains to that period when the asset is still getting ready for its intended use, that borrowing cost cannot be charged off as an expense in that pre-construction period. So basically, suppose I have borrowed funds for 5 years and I have borrowed when the asset construction started. So at the beginning, when I have borrowed, I have started incurring interest cost. I am utilizing these proceeds from the borrowed funds for funding the construction activity for my factory building and machinery. Now I am incurring expenditure, but I am not getting benefit out of that in the same financial year. That means you cannot expense out that amount. You need to capitalize that. But interest on its own cannot be an asset. So interest cost gets capitalized on those assets which are being constructed, that is factory building and machinery. Now, when the construction is completed at the end of second year, 2 years time it took. Third year onward, the factory building and machinery are ready for their intended use. Interest expenses from the third year will be charged off as an expense in the statement of profit or loss. But what about the pre-construction period interest, that is initial 2 years interest cost? It must be capitalized along with all costs for construction which are being capitalized. The interest cost will also be capitalized, and once capitalized, then what happens? Along with depreciation of that factory building and machinery, the interest cost, which is already part of the capitalized cost at the initial stage, that is after 2 years completion. Thereafter, suppose the life of that factory building and machinery is 10 years. So 2 years of construction and 10 years of usage. So during the 10 year of usage, when depreciation is charged on factory building and on plant and machinery, by way of depreciation, even the capitalized portion of interest will get amortized over the life of the asset by way of depreciation. So that is all about capitalization of interest cost, and what will be its implication in your profitability statement, in your cash flow statement in your balance sheet. We are going to talk about that as well, along with writing some important notes. So let us begin writing some notes first of all. Under the heading capitalized interest, please write, when a firm constructs an asset for its own use or in limited circumstances for resale, the interest that accrues during the construction period is capitalized as part of the asset's cost. The reasons for capitalizing interest are to accurately measure the cost of the asset and to better match the cost with the revenues generated by the constructed asset. The treatment of construction interest is similar under US GAAP and IFRS. Capitalized interest is not reported in the income statement as interest expense. So you know, this capitalized interest, when any expense is capitalized, it is not directly reported in the income statement. It becomes a part of the cost of the asset and is reported as an asset in the balance sheet. So please write up these important notes and then I take you ahead. Alright friends, once we have completed writing this much, let us move ahead and continue writing further. Once construction interest is capitalized, the interest cost is allocated to the income statement through depreciation expense if the asset is held for use, or cost of goods sold if the asset is held for sale. Capitalizing interest results in it being reported in cash flow statement as an outflow from investing activities. This contrasts with the usual treatment of interest paid, which is reported as an outflow from operating activities under US GAAP and can be an operating or financing outflow under IFRS. So please write this as well and then I take you ahead. Alright friends, once we have completed writing this much, let us move ahead and continue writing further. For an analyst, both capitalized and expensed interest should be used when calculating interest coverage ratios to get a clear picture of company's solvency. Analysts should also adjust income by adding back any depreciation of capitalized interest. Now, first of all, what is this interest coverage ratio and what will be the implication of capitalization of interest? Let us try to understand. See friends, when we are going to learn the ratio analysis, various accounting ratios, we will be discussing the mode of determining a ratio, how to interpret a ratio, what will be the implication of a particular ratio, what analysis we draw from a particular ratio, if there is an ideal range of a particular ratio, what it should be in any given circumstances. We will talk a lot about that in detail. But right now, because a related point has been discussed over here, I need to discuss the implication in the context of a particular ratio, that is interest coverage ratio. Now let me explain what is interest coverage ratio. Suppose an entity has to pay an interest amount of $8,000 every year. So it has borrowed money and it has to pay interest of $8,000 every year. So the commitment towards that interest payment is $8,000 and the earnings before interest and tax, EBIT, or you can call it as operating income, that is $80,000. That means to bear the interest cost, the earnings before interest is $80,000. So you have to bear an expense of $8,000 and the earnings in your hand available for that is $80,000. To bear expense of $8,000, if you have $80,000 in your hand, you are having 10 times of money that is sufficient to pay off that interest. Correct? That is called interest coverage ratio, because precisely interest coverage is EBIT divided by interest expense. Now, most important thing is the objective of determining this ratio has nothing to do whether you are capitalizing your interest or charging off that interest as expense, because the bank that is funding this loan to you, that bank has given you a big amount of loan. That bank would want to check how much is your repayment capacity towards that loan and how much is your tolerance or bearing capacity with respect to the expenditure towards interest? Are you able to generate that much income that you can bear this interest cost at least? The answer is yes, in the context of example that I gave you, where the denominator interest expenses annually were $8,000 and earnings before interest and tax, that is your operating income or your operating profit, is $80,000. So as I said, when you put that for computation, it will be $80,000 divided by $8,000, and that would give you what? 10 times. That means for every penny of interest that you have to pay, your income in hand is 10 times of that. That is the significance of interest coverage ratio. So what is this whole discussion implying? When you are making this ratio computation for analytical purpose, you have to be very cautious. Don't pick interest expenses only from income statement, because in income statement only that portion of interest will be reflected which is expensed out during the period, correct? What if there was some significant portion of interest that got capitalized? That if gets ignored, the denominator will be falling short and it will give you a false implication of a big value of your interest coverage ratio, which is not appropriate. As a result, when you are going for capitalization of interest, you should make sure that while computing this ratio, interest coverage ratio, you should consider in the interest component both the categories of interest, whether it is capitalized or whether it is charged off as revenue. Aggregate interest is what you have to consider. Now, this requires some adjustment in the interest, but it also requires some adjustment in the EBIT, because the amount of expense that was recognized as interest expense for the period, that would have been, considered for EBIT, because EBIT is to bear that cost. However, some component which was the capitalized value of that interest, in other words, where the interest got capitalized, in the earlier periods, if the interest would have been capitalized, what will be the implication? The capitalized cost of earlier years would now be depreciated, and some portion of depreciation would be because of the capitalization of interest cost earlier. So when you are making adjustment to EBIT, you need to consider the interest as well as the depreciation component, both the components should be considered. In other words, your EBIT should be including the capitalized amount of interest and the depreciation effect, if any. So if capitalized amount of interest you are adding to your EBIT, the depreciation component you need to deduct from the EBIT. So while dealing with ratios, we will be having these as calculative examples, and in this topic ahead also, when we are taking the calculative examples, I'll try to bring forward an example pertaining to this particular discussion. So as of now, I want you to write this down. This is something very, very important. Quickly write it and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and put our focus on the next point of discussion, that will be treatment of research and development cost. So when it comes to research and development cost, one fundamental question would arise: should it be expensed out or should it be capitalized? So here first of all, you need to understand that research and development is basically comprising of two terms. Research is something different and development is something different. So many people, they use research and development, R&D, as if it's one thing, but precisely from viewpoint of financial reporting, it is not one thing. Research is a different activity, development is a different activity. Let me give you an example. Suppose there is a US based pharmaceutical company, and the company operating in US has a big laboratory where lots of experiments are being carried out. Now this pharmaceutical company gets a new opportunity for making a research for a particular vaccine, for a particular type of flu a vaccine needs to be created, and the scientists and doctors have started making the research. So what is research and how does it differ from development? So in the context of the example that I gave you, there will be experiments after experiments that will be carried out, where the outcome of that experiment is unknown. Only maybe after carrying out some 35 experiments, it is the 36th experiment which proves to be successful. And then more trials are made and it is found that yes, this is working. When we conclude that something has become workable, we got the answer to the question, we got the solution to the problem, that is the end of the research. Then what is development? See boss, you have incurred a huge amount of expenditure on research. You would definitely want to recover this cost. How can someone recover this cost? One thing could be, you just share the finding of your research with the rest of the world. You declare this, that whichever pharmaceutical company is giving me the best bid, I will share this research outcome with them, and you can pay me in one lump sum, which will be enough compensation for my research expenditure and my profit over there. This could be one way. Another thing could be development. That means the pharmaceutical company that has carried out this research is now carrying out with the product development. Now it will be making drug out of that, it will be making a vaccine out of its own research work, and then that vaccine, that drug will be developed in terms of technical development, market development, and financially, economically, it will be placed in the market worldwide. As one sole supplier in the world, you may have a very good profitability when you are producing and supplying that particular product. So what is development? Outcome of a research when it is transformed into a marketable product, that is called development. So one thing is crystal clear, when you are at the research phase, you don't know the outcome. So the standards making bodies, whether it is US GAAP or IFRS, they have one clear phenomena: research expenditure should never be capitalized. Research expenditure cannot be capitalized. Research expenditure, no matter what is the amount of expenditure you incur, for whatsoever important activity you incur, if it is a research expenditure, it cannot be capitalized, it will be expensed out. However, under IFRS, development expenditure on fulfillment of certain criterias, the development expenditure can be capitalized, and the criterias, when all the criteria are met, then and then only you can capitalize the expenditure incurred during the development phase. So during the development phase, whatever expenditure you are incurring subject to fulfillment of the criteria, you are allowed to capitalize that expenditure, because now you know that you have something valuable in your hand and you are going to create an asset out of that. There is certainty that you will be able to create an asset out of that. That is why the criteria will be giving you big list of questions, whether there is technical feasibility that you will be able to develop the product, whether there will be a market, whether you will be able to make reliable estimate of the cost that you incur for development activity, and so many other criteria. So it will make you sure that you are going to find a valuable asset at the end through this developmental activity, and that is why development expenses under IFRS are allowed to be capitalized. Of course, capitalization of development expenditure will not create a tangible asset, it will create intangible asset. Therefore, this comes in the category of creation of an intangible asset. It could be a know-how, or if you have got your entire research and development patented, so it can be created as a patent right, where you can later on sell or use this patent rights for generating economic benefits for yourself. So that is all about research and development. Let us write some notes about the same. So please make sure that you have written this heading, treatment of research and development cost, and under that heading, when we talk about research and development cost, with some exceptions, costs to create intangible assets are expensed as incurred. Important exceptions are research and development cost under IFRS and software development costs. Under IFRS, research costs, which are costs aimed at discovery of new scientific or technical knowledge and understanding, are expensed as incurred. However, development costs may be capitalized. Development costs are incurred to translate research findings into a plan or design of a new product or process. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. To recognize an intangible asset in development, a firm must show that it can complete the asset and intends to use or sell the completed asset, among other criteria. As I said, there are many criteria that the entity will have to meet up. Under US GAAP, both research and development costs are generally expensed as incurred. Now this is one very important distinguishing point, that if it is application of US GAAP, then whether it is research expenditure or development expenditure, nothing can be capitalized. The whole research and development will be expensed as and when incurred. However, the cost of creating software for sale to others are treated in the manner similar to treatment of research and development cost under IFRS. So if it is developing a software which is with an objective of selling to others, then you are actually creating an asset, correct? In that case, the US GAAP will also follow the same criteria for research and development which is meant under IFRS. That means the research expenditure should be expensed out and development expenditure should be or can be capitalized subject to fulfillment of all the criteria. So let us write it down further, and the last point over here will be costs incurred to develop software for sale to others are expensed as incurred until the product's technological feasibility has been established, after which the cost of developing a saleable product are capitalized. Same criteria as you have the capitalization of development expenditure under IFRS. So please write up this entire point and then I take you ahead. Alright friends, once you have completed writing this whole thing, now here there could be a catch from the viewpoint of an analyst. Suppose you are an analyst and you have A incorporation and B incorporation which you are comparing. Now imagine that A incorporation has followed US GAAP, B incorporation has followed IFRS. That means the treatment of development cost by both of the entities are now different. And now you are going to compare their financial statements where research and development cost is included. So obviously, while making the analysis, while making the comparable statements, you will have to make certain adjustments and certain specific analysis which will be giving you the whole objective of comparing the financial statements crystal clear and there won't be any confusion. So here certain things needs to be accommodated. Let us note down that point. Over here you first write, to make the financial statements comparable for a company that capitalizes development costs with one that expenses such costs, the income statement should be adjusted to include development cost as an expense and any current amortization of development cost capitalized in the past should be removed. In the balance sheet, capitalized development cost should be removed, resulting in lower assets and equity. Adjusting the cash flow statement will require capitalized cost to be removed from cash flow from investing activities and include in cash from operation, which will decrease the CFO, that is cash from operation. So please write up this whole thing and that will be end of this entire discussion.